Good morning, everyone. Today, we're diving into the intangible economy, exploring how raw data transforms into market alpha. Our journey will trace the value chain of big tech, AI infrastructure, and digital assets. We'll follow the path from the initial data source, protected by an IP moat, refined by an AI refinery, and ultimately manifesting as market performance, with options for both stable growth and high volatility. Our core thesis is this: to truly understand modern valuations, we must trace the entire lifecycle of an asset from a user's simple click to its placement in an investor's portfolio. Let's begin with an executive summary of the digital asset value chain, broken into three key stages. First, the input, which is data itself. We'll argue that the new oil metaphor for data is flawed because, unlike oil, data is non-consumable, durable, and duplicates losslessly, requiring a unique refining approach. Second, the process, centered on AI and intellectual property. Value is captured through IP moats and refined by massive AI infrastructure. We're observing a circular AI deal machine, where tech giants fund startups that then purchase compute capacity back from the giants. And finally, the output market decoupling. A significant shift is underway, as Bitcoin's correlation with the Nasdaq 100 has collapsed from over 0.75 to approximately 0.40, signaling a clear split between growth tech and non-sovereign stores of value. Now, let's explore why the popular saying, "data is the new oil," is fundamentally flawed. While both are economically vital, their logistics differ significantly. Crude oil is consumed upon use, while digital data is non-consumable and durable, reusable indefinitely. Oil is a finite resource, data duplicates losslessly, and its volume constantly grows. Acquisition methods also differ. Oil is a pull model, extracted on demand, whereas data is a push model, streaming upon capture. And finally, homogeneity. Crude oil is fungible, with barrels being identical, but digital data is highly heterogeneous, varying wildly in format and quality. The implication of these differences is critical because data is not consumed, its storage volume grows exponentially, necessitating sophisticated refineries that can handle these constant, heterogeneous streams. This brings us to the economic reality of the free internet. The free service myth masks the truth that users are constantly paying with their data that is often worth far more than any subscription fee. For example, annual revenue generated per user varies significantly depending on the data type. Social media data might generate $30 to $80 per year, financial data between $150 and $300, and health information $100 to $200 annually. When we look at major platforms, Meta, or Facebook, generates around $120 per user per year, Amazon Prime members generate about $280, and Google generates over $400 per user. This illustrates the true value exchange happening behind the scenes. So, how do we turn these raw data streams into valuable insights? Through what we call the refinery. This process manages the volume, variety, and velocity of data across four critical stages. Stage 1 is acquisition, where data streams are captured from IoT devices and web pushes. Stage 2 is preparation, involving cleansing, transforming, and harmonizing this data to make it usable. Stage 3 is management, focusing on secure storage and privacy by design, often governed by strict regulations like GDPR, including encryption and the right to be forgotten. Finally, Stage 4 is provisioning, where refined data is delivered as valuable data products. This entire process ensures compliance and maximizes the utility of information. Beyond raw data, intellectual property, or IP, acts as a crucial legal moat and a powerful revenue engine. We see this manifesting in several ways. First, the ecosystem moat, where companies like Apple lock in users through design and user experience protections. Then there's the silent stream, exemplified by companies like Qualcomm and Microsoft, who earn billions by licensing chip designs and file systems to competitors, often quietly. And finally, trade secrets, the black box strategy. Google's search algorithm, for instance, is a trade secret, never disclosed in patents to prevent reverse engineering. This creates a powerful flywheel. New products lead to new IP filings, which generate licensing revenue or defensive blocking capabilities, fueling reinvestment and further innovation. But how do we value these invisible assets? The science of intangibles is critical here. It's noteworthy that goodwill and intangibles often make up about 2/3 of software acquisition prices. We use several valuation definitions to assess this. Relief from royalty asks what we would pay to license an asset if we didn't own it. The multi-period excess earnings method isolates cash flows specifically driven by the proprietary asset. And the with-without method values the business both with and without the asset to determine its contribution. Additionally, for SaaS businesses, we look at the SaaS rule of 40, which states that a healthy valuation typically has a growth rate percentage plus a profit margin percentage equal to or greater than 40%. Anything below that might suggest underperformance requiring operational or strategic adjustments. Let's turn our attention to the engine, the new physical footprint of AI. There's a significant shift occurring. While centralized hyperscale data centers in places like Mumbai are still crucial for intensive AI training, inference, the process of applying trained AI models, is increasingly moving to the edge. Locations like Tokyo are becoming edge inference colocation hubs. These emerging AI hubs are driven by two main factors: data sovereignty requirements and the need for economic efficiency. The shift means that while large-scale training happens centrally, low-latency and privacy-sensitive inference is performed closer to the data source and the end user. This brings us to the cost, the substantial capital expenditure, or CapEx, and the phenomenon we call the circular AI deal machine. In this model, big tech giants like Google and Microsoft make significant investments of capital into AI startups, such as Anthropic and OpenAI. These startups then, in turn, purchase cloud and compute capacity from the very same big tech companies, generating cloud revenue. This creates a circular flow of money. We're seeing unprecedented CapEx projections for 2025. Google is estimated to spend between $91 and $93 billion, and Meta is projecting a significant increase. This level of spending is currently outpacing revenue generation, drawing parallels to the infrastructure build-outs we saw during the dot-com era. In our Market Spotlight 2026, let's compare two giants, Meta Platforms and Alphabet. Meta is projected to have a compound annual growth rate, or CAGR, of 19%, with a valuation of 22 times forward earnings. They've effectively navigated significant headwinds, such as iOS privacy changes, and their ad revenue is now rebounding strongly thanks to AI tools. Alphabet, on the other hand, has a projected CAGR of 12% and a more discounted valuation of 19 times forward earnings. They face existential threats, including antitrust actions from the Department of Justice and potential Chrome spin-offs, while generative AI, like SearchGPT, is actively disrupting their core search business model. When considering ETF strategies, it's important to distinguish between broad tech exposure and pure play options. For broad tech, we have QQQ, the Nasdaq 100. This includes giants like Apple, Microsoft, Nvidia, but crucially also Meta, Alphabet, Amazon, and Tesla, offering holistic digital ecosystem exposure. In contrast, VGT, the Vanguard Information Technology ETF, represents a more pure-play hardware and software focus. It includes Apple, Microsoft, and Nvidia, but explicitly excludes Meta, Alphabet, and Amazon. This results in a high concentration of 45% in just 3 stocks for VGT. Our verdict is that QQQ offers significantly broader exposure to the full, big tech, value chain, encompassing critical areas like ad tech and e-commerce that VGT misses. Now, let's discuss the great decoupling between Bitcoin and big tech. The correlation between QQQ, representing tech, and Bitcoin has dramatically collapsed from over 0.75 to approximately 0.40 over the past 12 months. This divergence is evident in their performance, as you can see on the graph. This rotation is largely due to investors selling out of crypto to chase the high-growth AI mega-caps. The implication is profound. Bitcoin is evolving from a risk-on proxy, often moving in tandem with tech stocks, to an independent, non-sovereign asset class. This makes it a distinct entity in an investment portfolio. In this newly decoupled market, understanding the drivers of crypto volatility is key. First, there's macro sensitivity. Cryptocurrencies remain highly sensitive to the Federal Reserve's outlook and shifts in U.S. real yields. Second, market structure plays a role, particularly leverage unwind events. Perpetual futures markets can cause flash crashes during liquidation cascades, amplifying price movements. Third, whale psychology can impact the market. Long-term holders often engage in rebalancing, selling off portions of their holdings at psychological milestones, such as a projected $100,000 ceiling, to realize gains. Despite this volatility, our long-term thesis for Bitcoin remains strong. Institutional adoption and its fixed supply are still the core value drivers. To navigate this landscape, we propose the digital asset investment matrix, categorizing opportunities into three key areas. First, the infrastructure, representing growth. Here, we look at companies like Equinix and Nvidia, or an ETF like VGT, which capture the massive capex spend powering the AI revolution. Second, the monetizers, generating income. This includes companies like Meta and Google, or a broad ETF like QQQ, which monetize data and leverage their strong IP moats. However, it's crucial to watch for regulatory headwinds here. And third, the hedge, for diversification. This is where Bitcoin comes in, acting as a non-sovereign store of value, now largely decoupled from corporate earnings and offering a unique portfolio diversification benefit. Finally, let's establish some rules of the road for navigating the 2026 landscape. First, audit the inventory. Data is only valuable if it's refined. Look for efficient refineries and companies with strong IP moats. Second, mind the capex. Be wary of the circular AI deal machine, where investment might just be recycling within the ecosystem. Instead, prefer companies where AI truly drives bottom-line moats, not just raw volume. Third, know your vehicle. Avoid sector classification traps. For full ecosystem exposure, including ads and commerce, use QQQVGT, for example, misses key giants like Meta and Alphabet. And fourth, respect the decoupling. Understand that tech as a proxy for the broader market is evolving, and macroeconomic factors are increasingly influencing different asset classes distinctly.